Now that QE3 is over, the big questions: why did the Fed launch that third round of asset buying? And did the central bank's historic spending experiment really work? Steve Leisman takes a look.
The Fed's decision today to end the third round of quantitative easing leaves one simple $1.6 trillion question. Did it work? Did the $1.6 trillion of bond purchases in the program's 2 years achieve the Fed's goals of helping the U.S. economy, pumping up inflation, and lowering the unemployment rate? There's two ways to look at it. You can start with the U.S. data. Since QE3 was launched, growth has been a steady, if unremarkable, 2.5%, about a half point higher than it was before the program. Job growth ratcheted up from an average of 110,000 per month to 245,000 now, and the unemployment rate fell by about 2 points. The stock market surged. But another way to find out if QE worked in the U.S. is to look at Europe. Over the same time that the U.S. bought hundreds of billions of dollars of bonds, the balance sheet of the European Central Bank declined by €1 trillion. Now, central bankers on the continent are fretting over economies that are near recession and teetering on the verge of deflation.
History has told us that those central banks who tighten too soon have a lot of consequences that they then cannot deal with after a financial crisis. And the biggest mistake they can make is repeat 1937, repeat the Japanese situation, or repeat many European missteps more recently, and they don't want to be there.
Of course, QE had its failings. While the Fed tried to boost inflation, it actually declined during QE3. Bank lending has failed to rise strongly despite the Fed pumping billions into the system, and housing has floundered despite low mortgage rates. But supporters of the program say, just look at Europe. It could have been much worse here in the U.S. For Nightly Business Report, I'm Steve Leisman.